Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor. I'm speaking to you from New York City on this, the 7th day of January 2020. And as this is the first broadcast in 2020, let me wish all of you a joyful, prosperous, and happy New Year. Before I talk more about today's show, I always like to remind you that I write a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. You can subscribe to that by going to miningstocks.com. And we like to put in a little plug for Chen Lin's letter, What is Chen Buying, What is Chen Selling? It's chenpicks.com to sign up for Chen's letter. And Michael Oliver, who we'll be talking to in just a minute or two, it's olivermsa.com, olivermsa.com for his very prescient views on the markets, as you will see. And we'll be talking to him, realizing how well out ahead he is of most of his technical analyst peers. Well, we do want to thank you for listening to this show, making it one of the more popular shows on the Voice America Business Channel. We also want to encourage you to continue sending along whatever comments you have. Send them to questionsfortaylor@gmail.com. Questions, the number 4, Taylor@gmail.com. And, of course, we want to thank our sponsors, because without them, we would have no show. Our sponsors for today's show, we have 2 new ones, actually, Lion One Metals, and I'll be talking to an officer with Lion One Metals, as well as Quentin Henning in just a few minutes. Also want to welcome Sitka Gold Corp, which is a new sponsor to this show as well, and we'll be talking to them next week. An exciting news story, and you should realize that the companies that are sponsors of this show have first been added to my newsletter. I want to have sponsors on this show that I'm confident in and bullish on their prospects as well. And that is certainly true of all the sponsors that we have. In addition to Lion One Metals and Sitka Gold, existing sponsors are Irving Resources, Novo Resources, Great Bear Resources, Decling Exploration, and TriStar Gold Resources. This week's guests are Alistair McLeod, Michael Oliver, Dr. Quentin Henning, and for the first time, Amish Gregg. He is of Lion One Metals. Alistair wrote in his December 26th essay titled Bond Worries and Gold that, and I quote, Treasury bond yields may continue to rise, exposing the debt trap the U.S. government finds itself in. Market participants don't realize it yet, but the global monetary system is spinning out of control. This will become obvious as the crisis stage of the credit cycle now upon us becomes evident, end of quote. Well, Alistair believes that the outlook for monetary inflation is dire. Indeed, it was recently reported that 90% of all U.S. Treasury borrowings since September had to be funded by the Federal Reserve in order to avoid market crash-inducing interest rate increases. So it's hard to think of a more worrisome but still bullish picture for gold as measured in U.S. dollars. And I will be asking Alistair to help us understand how the dynamics of our current global debt problem is leading to debt problems and a financing insolvency for our government and how that might affect other markets. The fact that gold is honest money that holds its value over long periods of time, while every fiat currency ever created has been thrown into the dustbin of human history, that's the reason that I am a gold bug. And as a gold bug, I'm naturally interested in companies that discover the yellow metal and can make a profit from mining it. So I have written about a number of these companies in the past, and I'm very, very pleased to have with me today to talk to Dr. Quentin Henning, who really alerted me to the Lion One story, and that's when I added it just recently to my newsletter and made sure that I picked up some shares as well. So we'll be talking to Quentin Henning and Amish after the first commercial break, but right now I'm really pleased to tell you that Michael Oliver is back with us. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
It's really good to be back, and it seems like this is a year that may be quite exciting for those that are ready for it, and perhaps quite disturbing for those who are not. You've been talking last month or so, maybe longer than that, about 2 very quiet markets, namely the dollar index market and the commodity market as measured by the Bloomberg Commodity Index. And you suggested that those 2 markets are very close to a major turn of great significance, even though they've been kind of slumbering, sleeping, and not many people too concerned about them. Where do those markets stand right now, the commodity market and the dollar market? Do you see them making some major changes this year, some major changes in direction?
Absolutely. They did it December. The December close broke below on the dollar index our long-term momentum support structure that the dollar index had used all during 2019. The number adjusted each quarter. So the lows in 2019 aren't the same on a price chart, but on the momentum chart, they were all at the same level on the oscillator. That came out with the December close decisively. And therefore, we argue that the dollar is now shifted into downtrend. Now, it's not making any headlines at this point, but it's likely to make headlines soon. Meanwhile, at the same time, the Bloomberg Commodity Index broke out upside. Again, also a very quiet market. It's been quiet since 2016. And so nobody's paying attention to these two beasts, but they're big markets and they're major. Now, we think also their new trend direction will put wind in the sail of gold, which didn't need their help over the last year or two, but now has the assistance of those two markets to fuel its fire. Now, I caution everybody that the events that just occurred that sparked action out of oil, a dollar or so rally. It had already come up nicely recently anyway, but also caused gold to shoot up $40 the other night in the electronic market, up to 1590. Right now we're trading in the 1570s. But when news events like that occur, quite often it creates confusion, expectations, sometimes false moves. In the case of gold, I don't think it's a false move. It just got a little ahead of itself based on that news. And naturally, there were sellers up there, $15.90, $40 up on the day. And it backed off $20, $30, and now it's firming back up again. So don't be disturbed by the pullback. It was, an emotional moment, but in the direction that gold was already headed. Now, had gold been in a bear trend, which it's not, it's technically in a bull trend, such a rally should have been sold into. But in this case, the rally was legit. It just got a little too hot too quickly. Now, what I really like I'm seeing out there now is the stock market, because I think that's the next player as far as asset class movement that will help generate more upside in the gold market. The stock market is saying, beating its chest, saying, we don't care about that news. We're in good shape. And so, again, the sentiment level of the bulls, the forever longs in the stock market, has to be at about maximum because they had this event and yet the market did not go down. So they think they're invulnerable. It's our view that probably the S&P is making a top right about now. I'm guessing this, again, we haven't broken our numbers, but we have some specific layered numbers below the market that will indicate that, in fact, it is rolling over. But I suspect it's going to make its high, either made its high last week above 3250 on the S&P, or might make a new high this week, but watch it very carefully because I think if you roll over from these levels, there's a good chance you're making the top. And there's a lot of trigger numbers below the market that are not that far below that will do a lot of technical damage. It's not necessarily apparent on price charts, but it's apparent on momentum charts. And if we upset that market, what will be the response of the central bank? Well, we know what the response will be. More of the same, except even more. We even have a president who wants to print. So combine that with the ECB, the Fed, and the BOJ, and you've got nothing but pro-printers out there. So that's going to help what? I don't think it's going to help the stock market. It'll flow, it'll create a river of liquidity, but the river of liquidity this time will go into the gold market, is our argument.
So, Michael, the issue here then is if money starts to flow out of the equity market, I suppose it also really goes into the treasury market. But at what point in time, I mean, we're going to be talking to Alistair McLeod in the second half of this show today, and he's really concerned that we're going to start to see rising interest rates no matter what the Fed does. Yep. No matter what the Fed does. I think
the only threat of being short the bond market or expecting higher yields is that at moments when the S&P has sharp declines, mini crashes or a crash type event, you will have the natural panic of investors rushing in to buy T-bonds. And so you'll have an upside spike or a drop in yields. But the damage that has already been done to the bond markets, I'm talking the Japanese, the German, and the U.S. government bond markets over the last few months, argues to us that we are probably in transition toward higher yields, with the caveat that if you ever get a moment of a dark moment in the stock market, especially its emotional one, you will have a rush back into T-bonds, but it will be a flare rally in the T-bonds, not a trend-changing rally. I think the bonds have a problem. Yields are going up. And that will leave one asset category out there, basically.
Yeah, that's right. Gold. Gold and the monetary metals, probably and silver, too. Metals.
Yeah,
right.
Absolutely.
And maybe to a lesser degree copper and some of the other metals. I mean, you're seeing a bull market entirely over the commodity markets, right? That's what you're seeing now.
If you're a smart investor and just look at the charts, you've had the commodities beat off the page as of 2016. They haven't gone down since then. They've gone sideways, Bloomberg Commodity Index. So they're not a bear. They're a sideways market. In our view now, they're up. But if you're a value investor and you want out of the stuff that is a bubble, you look over at the commodity category and you see no potential probably for downside risk. The issue is, are they ready for upside? And we argue they are.
All right.
So I think smart money's making the move already.
All right. Well, it certainly is shaping up for a fascinating year if you're long on commodities and gold, that's for sure. Thank you very much for being with us.